Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing the fact that the Bank of Canada is reducing its bond buying program. They are the first G7 country to indicate that they are going to slow down their quantitative easing, and we're going to talk about what that means for mortgage rates and what it means to you and the overall economy. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing to this channel. It's free, it's definitely easy, and a huge thank you to the 2,000 plus subscribers that have subscribed in the last month. I very much appreciate each and every one of you. The definitive guide on how to manage your credit, product, and elite price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it and let's discuss this on what seems to be the fastest real estate investing and specifically mortgage channel in Canada right now. I don't know if it's actually any of those things, but hey, we're growing at a pretty fast clip and I'm pretty proud of that, and I'm glad I get to share this information with you. So the Bank of Canada has said they're pulling back on their bond buying program. They are the first Federal Reserve Bank in the G7 to do so, which means they are strategically going to start slowing down the amount of money that they're injecting into the economy. And specifically what that means is it means that they're going to start to taper down their purchases of $4 billion in Canadian bonds per week down to $3 billion starting in April. They didn't have a formal announcement of this, but in a meeting with the Deputy Governor, Tony Gravel, Tuesday, he started talking about the fact that they were going to start tapering. And let's talk about what this means, because what this is this is a signal to the economy. So they didn't come out with an announcement. They didn't come out and put it out in a press release or do a big press meeting. What they did is they said publicly that they are going to start reducing the amount of bond buying that they're going to do. This was widely expected, but the reason they did it in the manner they did, the reason they did it in basically an unrelated speech, is because they were trying to signal to the market that, hey, we need to slow things down a little bit. We don't want to take the steam out of the economy by making a big unexpected announcement and scaring people. But what we do want to do is send a signal to the market that you need to start maybe slowing down your borrowing. And I think this is specifically related to the real estate market, because it's pretty clear that real estate's getting a little bit overheated. Yes, the Bank of Canada is watching speculators. Yes, they are a little bit concerned about where housing prices are going, especially in markets like Toronto and Vancouver and the outlying areas. And this is something that they are watching very closely. And it's this type of signal that a central bank will send, and I think I call it a Federal Reserve Bank. That is what is in the US, but a central bank will start to try to send signals to a market before actually making any major policy decisions, so that the market can ease into the changes that are being made. And the bond market has already priced this into bond yields. They widely expected that this was going to happen at the March meeting. It didn't, but essentially bond yields have been going up for the last few weeks. And if you take a look at the actual bond market here, you can see that since January, they've gone from about 0.5% on a 5-year government bond, which is the bond that the 5-year fixed is priced off of. And the rate has increased up to a level at its highest of about 1.03%. And what's interesting is that after this conversation was had, after the signal was sent to the market, the bond yields actually started to come down. As of today, they're at 0.93%. So earlier in the week, we saw lenders increase their 5-year fixed rates, thinking that they were going to need to because the bond market continued to rise and rise and rise. And then as of today, we're starting to see the monoline lenders and some of the banks lower their 5-year fix by about 0.1% again, because what seems to have happened is this conversation that the Bank of Canada has had and that the Deputy Governor has had has sent a signal to the market that what they expect to happen is going to happen, and therefore the bond yields are starting to come down because there's less people pricing that in as an expectation. Now, what does that mean for you as a consumer? Well, what it means is as they slowly start to taper down their bond buying, that means there's going to be less demand for the bonds. And when there's less demand for the bonds, the prices will go down. And the prices have an adverse relationship to the yields, which means the yields will go up, and eventually over time, over the next 2 to 3 years, fixed rates are going to increase accordingly as the economy starts to ramp up, because as there's less demand for bonds, those yields will increase, and you'll probably start to see 5-year fixed rates in the 2.5 to 2.75 range. Now, that doesn't necessarily mean that you're going to see variable rates increase, because the Bank of Canada is still holding pat in the fact that they are going to not increase interest rates, at least the Bank of Canada rate, until 2023. So what that means is that while fixed rates are probably going to go up a little bit in price, you're going to continue to see a pretty big discount on variable rates. And here's the thing is they're going to have to slowly taper this, and think of every $1 billion per week less that they're buying in bonds as essentially a rate increase without it being a rate increase. They're taking the stimulus out of the market, and essentially taking that stimulus out of the market is essentially the same thing as doing a quasi-rate increase. So they're going to have to get all that bond buying stimulus out of the market before they can even think about increasing interest rates. So it's still probably going to take a year or two for them to get to the point where they're buying no more bonds than what are coming up for maturity, and then they're going to start thinking about increasing interest rates. So it still looks like we are at least until 2023 before prime rate goes up, and therefore before variable rates go up. Now, one thing that I thought was interesting in the last couple of days with respect to the news is if you look at, and I'm going to put you back into my screen here, if you look at the recent news from RBC came out this week and said, hey, we should put everything on the table to slow down the real estate market. Now, this is interesting because Polas, the former governor of the Bank of Canada, said this week that if a hot housing market is what it takes to get the economy going back and roaring again, well, then absolutely it's worth it, and he is willing to accept a hot housing market in order to make sure the economy stays stable. Now you've got RBC on the other hand saying, hey, we need to slow down the housing market because we aren't liking the amount of risk that we have to take as a lender. So instead of us stepping in and saying, hey, we're going to take on less mortgages and less financing, basically what they're saying is we would like the government to step in and put all of the things that they could possibly put on the table in order to slow down the housing market, which includes things like what they're calling sacred cows, the capital gains tax exemption. So in Canada right now, if you own a personal property and it goes up in value and you sell it, guess what? You get to keep the capital gains without paying any taxes on it. Now, if you have a property that you don't live in and you sell it, you have to pay capital gains taxes. But what RBC is suggesting to the government, which, RBC being the biggest bank in Canada is a pretty big lobby, they're saying that perhaps things like the capital gains tax exemption should be taken off the table in order to slow down the housing market. Now, I don't know about you, but I'm not a huge fan of a bank saying to a government, hey, why don't you step in where we're unwilling to? And here's the other side of this, and they're also talking about things like increasing the down payment amount, the minimum down payment amount. Well, that's probably not going to happen because the government isn't going to want to do things that affect first-time homebuyers and subsequently reduce their chances of getting elected. And I think that reducing the capital gains tax exemption is probably something that would cause them to maybe not get elected again. Now, the other side of this coin is that if they need to pay for all the spending that they've done in the last year, the capital gains tax exemption is a pretty low piece of low-hanging fruit that they could use in order to pay for some of those bills. But I think it's interesting that this is something that RBC is suggesting, and I love RBC as a bank. I think they do commercial banking really well. I think they do investing really, really well, wealth management for sure. But I'm not sure that I love the fact that a Canadian bank is saying to the government, hey, we want you to step in and slow down housing, especially when you've got a former governor of the Bank of Canada saying, hey, I will take a hot real estate market any day in order to save the economy. So there's some interesting things happening here. The long and short of it is this: the Bank of Canada is taking some of the stimulus out of the economy. They've said that they don't want to own more than 35% of Canadian bonds. So therefore they're slowing down. What that means is that they're expecting that the economy is picking back up at a fairly reasonable amount, and therefore that they can start to pull back some of those things. Bodes pretty well for Canada, the fact that we are the first G7 country that can start to pull back some of those quantitative easing incentives. But keep in mind that this is a signal to the market. This is the Bank of Canada saying to the market, hey, We know that you like borrowing, we know that you like housing, but you need to slow it down just a little bit. So that's the news on the Bank of Canada finally taking and pulling back some of their quantitative easing. I hope you found this video useful. If you did, do me that favor, hit that subscribe button, hit that notification bell, hit that like button so more people like you can see this video, and don't forget about our race to 10,000 subscribers. I fully suspect we're going to pay somebody's monthly mortgage or rent payment by June of this year. Cheers, we'll see you on the next video.